Palisade Radio is brought to you by First Majestic Silver Corp, one of the world's purest and fastest growing silver mining companies.
Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. On the line with us today is returning guest, very popular guest last time we had him on. His name's Ronald Stoeferle. Most people know who he is. He authors the In Gold We Trust report. This year's edition is coming out on June 28th. We'll be finding out where to get that later in the interview. Ron Stoeferle is also a fund manager at Incrementum. Ronnie, welcome to the program.
Hi, Colin. Good to be back.
Yeah, I would refer all of our listeners to the last interview we did last year because it was more of a generalist conversation about the havoc that inflation can cause on the monetary supply. And that's a theme that you can talk about time and time again. But I want to ask you, what is going to be new in the In Gold We Trust report this year?
Well, we already wrote like 120 pages. There's so much to discuss and research these days. Of course, we will write about gold itself. If the correction or the bear market is already over, or if it's just a fake. Then we also will be writing about inflation, of course. That's the topic that we focus on in our investment process. Will price inflation keep rising? Will we see some sort of stagflation going forward? We also will discuss the upcoming interventions like helicopter money, perhaps a ban on cash, further measures of financial repression. We will discuss the permanent portfolio and gold's role in the permanent portfolio. We will discuss the past, the present, and the future of the monetary order. We'll talk about valuations of gold stocks, and some technical aspects. So it's going to be quite a read, and honestly, it's only 4 weeks to go. So we will be writing and layouting and correcting 24/7 the next 4 weeks. And I hope that all of your listeners will enjoy the report. It's gonna come out on June 28th.
Well, Ronnie, I'm very proud of our research channel, Palisade Research. We, of course, focus on the mining stocks, and we've done some pretty compelling charts over the last couple months, which I believe some of them might show up in the In Gold We Trust report, which is truly an honor. So thank you for including some of our research. But I want to talk about some of the most recent charts that you saw that we put out, which was comparing the mining bull market that we've started in January to the first year of mining bull markets in the past. The big question being, is this a false start or is this the real deal? What do you think?
I think it's the real deal. Just to let you know, when I'm talking to investors, to private bankers, to pension fund managers and so on, most of them keep saying, gold has had quite a run in the first quarter. It was the strongest quarter, I think, in 30 years. Up 16% in dollar terms. Mining stocks more than doubled within a couple of weeks. So everybody said, I'll wait for the consolidation. It's already extremely overbought, and then I'll start buying gold again. So I thought there must be quite a lot of money on the sidelines. Now, when I'm talking to those investors, most of them say, it has been a bear market rally. I don't believe in this move in gold and the mining stocks and so on. And I think it's really funny that really none of them started piling into gold again. And I think we all know this herd mentality. Probably they will start buying at 1,300 or 1,400 big time. So what I want to say is there's quite a lot of money on the sidelines still. Nobody really participated in this move in the first quarter, and therefore I think that also from a sentiment perspective, I think it's the classical cycle, and we have seen desperation and depression in gold and the miners, and now it's the upcycle is beginning, and I'm really looking forward to it.
Well, what I find most interesting, and I'm sure you've been paying close attention, is the fact that the mining stocks had a significant move up despite the fact that gold didn't move too much, and that just goes to show how depressed these things were, how much leverage exists in them. And even we've seen gold retreat about $100 an ounce in the last week or two. The mining stocks have come down, but they haven't come down very much, which is something we haven't seen over the last few years. What's your interest in the mining stocks as opposed to the physical metal?
Well, I like both. I mean, people often ask me, do you prefer physical gold or mining stocks? I say, it's different asset classes. Gold doesn't have any counterparty risk. It's a monetary insurance. As I keep saying, it's a soft metal, but it's a hard currency. On the other hand, mining stocks definitely got a different risk profile. At this point, I definitely like both. I think mining stocks, they basically did what the energy sector is about to do. So what they did in the last few years is they consolidated their balance sheets, they reduced their costs, they hired new management, they focused on profitability again, they sold expensive projects and so on. So I said already last year that the upside for mining stocks is even more asymmetrical. I think that the beta on a rising gold price is much higher than a few years ago. And therefore, I think with this move in gold that we have seen, we could see that there's an enormous amount of opportunity in mining stocks. I think the sector is not really represented in investors' portfolio. So at the moment, I think the total market cap of the MX Goldbucks index must be around 100 billion. So that's basically nothing. So we can all imagine what's going to happen if gold rises to 1500 or 1600. As you know, my long-term target for gold is the inflation-adjusted all-time high at 2,300 US dollars. So I think there's the risk-return profile is extremely asymmetrical at the moment, and therefore, I just like the risk-reward ratio.
You hinted at some of this year's themes that are going to show up in the In Gold We Trust report, and we can't give away all the goodies on this interview, but let's talk on some of them in context of today. One of the looming consequences of Fed policy over the past few years has been the emergence of negative rates, which are popping up all over the place. And a lot of people, including yourself, seem to think that that's going to have major implications for the price of gold. Talk about what's the problem with negative rates and what they might cause.
Well, at the moment, we're already seeing negative rates in 5 different currency areas, representing, I think, 23% of global GDP. So that's already quite a lot. I think 2 or 3 years ago, nobody would have dared to discuss the implementation of negative rates. Nowadays, people are only talking about the level of negative interest rates. So it's common sense. Basically, everybody believes that negative interest rates are something that do not cause any harm. That are just okay due to this crisis. From my point of view, what we would need would be much higher interest rates. So as you know, I'm not only from Austria. I'm also adhere to the Austrian School of Economics. We wrote this book, Austrian School for Investors, and of course, we know that a planned economy doesn't work, and therefore I don't think that the management of interest rates, which is the by far the most important price in an economy, I don't think this works, and the natural rate of interest cannot be negative. So there's quite a lot of damaging and negative consequences of low and negative interest rates, not only to financial markets, but also to morality, because people just stop saving. They are consuming, and yeah, consuming doesn't make an economy rich and prosperous. We first need savings, then investments, and then you can consume. So there's quite a lot of negative consequences, and I don't rule out that the US will also sooner or later implement negative rates. In fact, the Fed already has I think it's called adverse scenario on their webpage, where they say that they would be implementing negative rates. Janet Yellen just wrote that it would be a good idea implementing negative rates in a recession. So I think sooner or later the US will also join the negative rates club. And of course, when you talk to I would call them gold haters, a couple of years ago, most of them said, I don't buy gold because it doesn't pay any interest. Now you have to say gold doesn't cost any interest. So of course, negative rates are definitely positive for gold because it lowers your opportunity costs. And therefore, I think that the overall environment for gold is extremely positive. I think that the US will sooner or later enter recession, perhaps already in 2016. And of course, we all know that the Fed and the politicians will react. There will be fiscal stimulus. There will be perhaps another round of quantitative easing. There will be the implementation of negative rates. And that all should be pretty positive for gold.
Ronnie, one could argue that the U.S. is already in a recession. Past guests of the program, including Peter Schiff, say we've been in a recession. Doug Casey is another one. But the numbers in the U.S., they never seem to be realistic. Things seem bad, and yet government unemployment numbers come out, or GDP figures, and concerns are calmed for another month, or the Fed meeting comes out, and somehow the stock market has another leg up. When do you think that we finally see a generally accepted reemergence of a recession in the U.S. where everybody knows and accepts that that's where we're at?
That's a very, very good point. I think most of the numbers that are published are basically not showing what's really happening in the U.S. Having a look at manufacturing numbers, industrial production, the rail freight volumes, and so on. It all shows me that the situation is getting worse and worse. So I think all those discussions on CNBC about the U.S. economy doing so well, they're all rubbish. They're all fake. From my point of view, a recession, don't get me wrong, a recession is something just normal and healthy. It's perhaps a bit like the need of the body to sleep. And you can drown, I don't know, 10 cups of coffee or 10 Red Bull to avoid falling asleep, but that's not gonna be positive for your body. And therefore I think that recessions are for the longer term something just normal and healthy for every economy. And the longer you try to avoid it with rates and monetary and fiscal stimulus, the worse the reckoning will become sooner or later. We shouldn't forget that we've got an election year this year, so there will be quite a lot of political chatter around, and therefore I think that in fall there will probably be more discussions about the recession. However, we know that the official confirmation that we're in a recession is only given, I think, 6 or 9 months after we entered the recession. So perhaps we're already in a recession, but it will be acknowledged only in a couple of months. From my point of view, it's crystal clear. Most of the important economic indicators are worsening, are deteriorating. We're seeing the consequences of the strong dollar, and therefore I think a weak dollar would actually be quite reflationary for the whole world, not only for the US but also for emerging markets, especially China. and therefore I'm not really bullish on the US dollar. I think that our advisory board member Jim Rickards, he mentioned in our last advisory board discussion that something like a Shanghai Accord happened at the last G20 meeting, and that the most important politicians or countries decided to lower the dollar to kind of reflate the system and release pressure from the system. It seems that it doesn't really work because everybody now believes that the Fed will hike rates in June. I don't really think so. If they're gonna do it, there's gonna be massive consequences on financial markets. I'm pretty sure. Just like when they raised rates in December and the markets reacted in January and February with a big correction. So I think it's an extremely fragile situation, and a lower dollar could release some pressure from the system. And therefore, I think the overall picture for gold is so convincing that I think it's a great opportunity having slightly lower prices now especially as we're probably at the beginning of the next leg up.
Ronnie, I know you're running on a tight schedule today. Do you have a couple more minutes, or do we need to conclude at this point?
No, sure.
Well, I want to ask you about your expectations between this year and the next year. You're obviously setting out what you could call some predictions, some analysis, some historical research on gold in the context of the economy today. Do you have any thoughts as to, in the next 12 months, what you're looking at might actually come to be? Like, what's the world going to look like in terms of gold in 12 months from now?
Oh, good question. I think that one has to be careful with target prices. So I think the price target that I put out the first time when I published a report, which was almost 10 years ago, it was $2,300, which was the inflation adjusted all-time high. I still stick to that target. I think that inflation will become a topic. We should not forget that politicians all over the globe are saying for years now that they are introducing negative rates, that they're doing QE, etc., just to avoid deflation and to make higher inflation rates happen. From my point of view, if you study history, central bankers and economists are underestimating inflation dynamics. So once the genie is out of the bottle, it's out and you can't control it anymore. So I think that's a very dangerous game. I think the oil price is definitely crucial going forward. You don't find any oil bulls anymore. Everybody is still extremely bearish when it comes to oil. I think that it's a bit similar like 3 years ago, when you said 3 years ago that you would expect oil going below $100. Everybody would have said that's impossible. It will never happen again. Now, if you say nowadays that you expect oil to rise to $80 or even $100, everybody's gonna say that's not gonna happen, never ever. So I think we're seeing extremely very strong negative sentiment regarding oil, and if we're seeing rising oil prices just due to the base effects, we will see massively rising inflation numbers. So if we're gonna see that and weak economic numbers, then I think the central banks would be in some sort of a dilemma, because they would have to raise interest rates because of high inflation, and that's gonna be a tough decision for central bankers, of course. It's a bit like in 2011 perhaps. So I think inflation, rising price inflation will become a topic again. Stagflation will become a topic, and therefore I think that's a very positive environment for gold. And I wouldn't rule out to see gold at 15 or 1600 in the next 12 months, perhaps even higher. I think that, you know, from a technical perspective, the overall picture looks extremely promising. We have seen this extremely negative sentiment last year, also because of the interest hike in the US, where everybody said, okay, the Federal Reserve will be hiking rates 4 or 5 times, and gold got crashed but it came back. So I think we have seen peak bearishness in gold last year. Sentiment is still pretty negative, and I think this is gonna dramatically improve. So we are also drawing quite a number of comparisons between the 1970s mid-cycle correction. It's pretty similar. We have also seen a correction of roughly 45% in the 70s, and we all know what happened from 1976 until 1980. Gold rose 800%. So you know, history repeats. But I don't know where we will end in a few years. I honestly hope that we won't see gold at 10,000, because that would also mean that we would see massive problems, social disorder and all that stuff. So I really one should be careful what one wishes for, because it might come true. I don't hope that gold will rise to 10,000, because then we probably would have other problems.
All right. Well, Ronnie, thanks so much for coming on the show. Ronnie Stoeferle, fund manager at Incrementum. As I promised at the beginning of the program, Ronnie, how does everybody get signed up so that on June 28th they get a copy of the In Gold We Trust report?
Well, we're publishing it on our webpage, incrementum.li. But I think it will be also on Zero Hedge, on plenty of other websites, perhaps also on your webpage. I'll definitely send you the link. It's totally free of charge. We will also publish a shorter version, roughly 15 to 20 pages, and also a chart book highlighting the best charts in the report. So there's going to be quite a lot of stuff to read end of June, and yeah, I'm really looking forward to the moment when I'm hitting the send button, because then the work is basically over. But until then, there's quite a lot to work.
Yeah, well, absolutely. Where else can you get 120 or might end up being 200 pages of free content on everything gold? So I'm looking forward to that coming out this year. Last year's report was excellent. Ronnie, thanks so much for coming back on the program.
Thank you very much, Colin. It's been a pleasure. Thanks a lot.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen? Or are you too stupid?